Welcome to Capital Allocation Lab.
Subscribe and like to support more educational episodes. And one quick reminder before we really get into things.
Right.
This is educational content only. It is not individualized investment, legal, tax, or, accounting advice.
Exactly. So today we are diving into a massive paradox, one that's basically hidden in plain sight inside Chapter 15 of the classic text, Security Analysis by Graham and Dodd.
Yeah, it's a huge one.
Right. And our mission today is to really tear down this illusion of safety that ends up costing income investors millions.
Millions.
We have a very specific, almost deceptively simple question to answer for you today. If a preferred stock pays a higher yield than a bond, is that extra yield a reward for safety?
Or, and this is the crux of it, is it a blaring warning siren that the safety has already been compromised?
That framing gets right to the heart of the danger, I think.
It really does. Graham and Dodd would tell you that the higher yield is, it's almost always a warning first. It only becomes a reward after the underlying numbers of the business have absolutely earned your trust.
That's true.
The core objective of our conversation today is to examine why so many investors, even the professionals, fall into a very specific mathematical trap when they look at preferred stocks.
And we want to equip you, the listener, with the rigorous tools required to see through what is essentially an accounting mirage.
Exactly, the mirage of safety.
It feels like this is just an eternal mistake in the markets,
Yeah.
The wrapper around the security changes with every single economic cycle.
Oh, absolutely.
Like sometimes Wall Street is heavily pushing utility preferreds. Other times it's bank preferreds or these new hybrid income securities.
Or an entire exchange-traded fund just packed full of these things.
Right. But the core investor error remains remarkably and tragically stable across generations. People see the word preferred, and they see a dividend rate that is maybe a point or two higher than a standard bond.
Yeah.
And they quietly, almost unconsciously, assume they're getting paid more for roughly the exact same level of safety.
Because the word preferred just carries this immense psychological weight.
It really does. It sounds privileged.
It implies that you are, at the front of the line, shielded from all the chaos of the common stock market.
But Graham and Dodd dedicate this entire chapter to completely dismantling that assumption.
They do. They argue that the assumption is exactly backwards. A truly investment-grade preferred stock actually has to meet all of the stringent requirements of a good bond, and then...
And this is the kicker.
Right, and then it needs an extra margin of safety layered right on top of that.
But wait, why demand an extra margin of safety? If it's a fixed income instrument, shouldn't it just be judged on the same fixed income scale?
Well, it requires an extra margin because the preferred holder occupies a significantly weaker contractual position. You do not have the legal teeth of a bondholder. So if you are going to accept a weaker contract, you absolutely must demand a stronger business to compensate.
That feels like the thesis of the entire chapter right there.
Yeah.
It needs the safety of a bond plus an extra margin of safety. But what makes Graham and Dodd's approach so brilliant here is that they don't just, hand you that rule as a bumper sticker.
No, they prove it mechanically. They show you exactly where the public is mathematically misled.
They show you how salty calculations create this completely false feeling of security.
Yeah, and today we are going to walk through how legal form can easily distract you from economic reality.
And why a security that looks wonderfully conservative in the glossy sales brochure can actually be dangerously hollow in the capital structure.
So we need to keep this highly practical for you listening. We'll start with the core principle of what a preferred stock actually is, structurally.
Right.
Then we'll look at the tougher numerical standards Graham and Dodd require for them. From there, we'll dissect the biggest analytical trap in the chapter.
The mathematically wrong way to measure preferred coverage, which, by the way, is a mistake still happening today.
Unbelievably, yes. After that, we'll cover the stock value ratio, the impact of having bonds ahead of the preferred stock, the specific structural danger of non-cumulative dividends.
That's a huge one.
Right. And finally, the broader philosophical lesson about what truly matters when you are trying to protect your principal.
So to lay the groundwork here, let's translate sort of the foundational jargon.
Let's do it.
Before we analyze the safety of the instrument, we have to define exactly what the instrument is. Where does a preferred stock actually sit in the capital structure in practical, everyday terms?
Well, in the most basic structural terms, a preferred stock is a fixed claim security that sits right in the middle ground between debt, like your senior bonds, and common equity.
Okay.
It has priority over the common stock when it comes to receiving dividends, and it usually has some level of liquidation priority if the company goes under.
Right.
But, and this is the foundational crack that you really have to understand, it completely lacks the hard legal enforcement rights of a bond.
Let me pause you right there, because that lack of enforcement right seems massive.
It is.
If I own a corporate bond and the company misses an interest payment, I have legal leverage, right? I can force an issue. I can potentially push the company toward bankruptcy or reorganization to get my money. But what actually happens if the company just decides to skip my preferred dividend?
If the company skips a preferred dividend, you, the holder, generally cannot compel payment the way a bondholder can legally enforce an interest payment.
Wow.
Yeah, you cannot force the company into bankruptcy or reorganization simply because they missed your preferred dividend check.
So you're structurally subordinate.
You are. You are along for the ride, basically hoping management does the right thing.
So if we build an analogy here, it's kind of like being seated in the middle rows of an airplane.
I like that.
The bondholders are sitting up in first class right next to the emergency exit. If the plane goes down, they're getting off first by ironclad contract.
Yep, they have the legal right.
The common stockholders are way in the back. They know they bought the cheapest ticket and they are taking the most risk. But if the airline is wildly successful, they get all the extra profits. But the preferred stockholders are stuck in the middle. They paid a premium for priority boarding over the folks in the back, but if the doors jam and the plane is on fire, they don't have the legal right to pull the emergency lever like the folks in first class.
That visual captures the dynamic perfectly. You are stranded in the middle. You get less certainty and less legal protection than a bondholder.
Yeah.
But you also get significantly less upside than a common shareholder because your dividend payout is strictly capped.
Exactly. If the company's profits triple, your preferred dividend does not go up a single cent.
Which brings us back to that extra margin of safety rule. If I am stranded in that middle seat with less certainty than the bondholder and absolutely no legal enforcement mechanism, why would I ever accept a standard of financial safety that is merely equal to the bondholders?
You shouldn't.
No, you shouldn't. And that is the exact logical leap Graham and Dodd are making. They insist that an investment preferred stock must satisfy all the requirements of a good bond with an extra margin of safety strictly to offset its weaker contractual position.
That phrase, extra margin of safety, is just the absolute hinge of this analysis.
It really is.
Because if you think about how these securities are routinely sold to the public, the sales pitch is almost the exact opposite of this logic.
Oh, absolutely. The sales pitch is always framed as a gentle, reasonable compromise.
Right. The broker says, look, you get a little more yield, maybe 6% instead of 5%. And sure, you take a little less seniority in the capital stack, but this is a massive blue chip company.
There really isn't much difference in the grand scheme of things.
It's basically a bond that pays more.
And that is exactly what Graham and Dodd are fighting against here. The industry frames it as a slight, totally acceptable trade-off.
Yeah.
Graham and Dodd say, no, the difference in legal rights is so profound, so structurally important, that your analysis as an investor must be vastly stricter, not looser.
They aren't arguing that all preferred stocks are inherently bad investments, though.
No, not at all. They are arguing that the investor must become far more exacting. You have to demand more proof of safety, not less, precisely because nobody is legally forced to pay you.
That is such a crucial lesson for anyone trying to allocate capital intelligently. The takeaway isn't about avoiding an entire category of investments.
Right.
It's about refusing to let the label of the security substitute for doing the rigorous underlying work.
And there is a deep behavioral trap here that we really have to acknowledge. Investors tend to become far too forgiving when a security has an income flavor.
Yes, that income flavor is so seductive.
When an instrument pays a regular fixed dividend quarter after quarter, it feels settled, it feels permanent, it creates this powerful aura of stability.
And that feeling of security can be dangerously unearned.
Exactly.
It's the illusion of safety generated by sheer routine. Because a check arrives in your account every 90 days, your brain naturally assumes the underlying corporate architecture generating that check is made of solid granite.
But it might actually be made of balsa wood.
Exactly. Graham and Dodd want you to stop asking the immediate, reflexive question, what is the yield? And force yourself to start asking the structural question.
What actually protects this claim when things go wrong?
Which leads us directly into the first hard quantitative test of the chapter, average earnings coverage.
Right. Now that we know we need stricter standards, we have to quantify what stricter actually means in practice.
So Graham and Dodd provide minimum average earnings coverage standards for investment-grade preferred stocks.
And they are deliberately, noticeably tougher than the standards they set for bonds.
I really want to slow down here and look at the actual numbers they provide, because the thresholds aren't just arbitrary guesses.
They're very specific.
Let's walk through their minimum average earnings coverage standards for preferreds versus bonds, broken down by industry category.
Let's lay them out. We will start with public utilities. For public utilities, Graham and Dodd suggest a minimum average coverage of 2 times fixed charges plus preferred dividends.
Okay, so the total burden needs to be covered 2 times over for a utility preferred. Just to compare, what was their standard for utility bonds?
For utility bonds, the standard was lower, 1 3/4 times fixed charges.
So 1.75 times for the bond, but stepping up to a full 2 times for the preferred stock.
Exactly. Now let's move to railroads. For railroad preferreds, they demand coverage of 2.5 times.
And for the bonds?
For railroad bonds, the standard is only 2 times.
2 times for the railroad bond, 2.5 times for the railroad preferred. And what about industrials? Manufacturing companies, retailers, that sort of thing.
For industrial preferreds, they require a massive 4 times coverage. For industrial bonds, it was 3 times.
Let me make sure I'm fully digesting that. 3 times for the industrial bond, stepping all the way up to 4 times for the industrial preferred.
Right.
The underlying principle there is incredibly consistent across all 3 categories. If you own the weaker contractual instrument, you must demand a stronger mathematical protection to compensate.
Exactly the point.
But what really stands out to me here is that they don't just adjust the required multiple based on the instrument. They adjust it based on the business quality first.
That's a huge point.
Utilities have the lowest hurdle at 2 times. Railroads are in the middle at 2.5 times. Industrials have the highest hurdle by far at 4 times. Why the massive variance between a utility and an industrial, right?
Because Graham and Dodd do not treat preferred stocks as abstract financial concepts just, floating in a vacuum. They care deeply about the economic reality of the business generating the cash underneath the security.
Right.
Think about the fundamental nature of these businesses. A public utility, historically, is a regulated monopoly. People pay their power and water bills every single month, regardless of what the broader economy is doing.
It has highly predictable, stable cash flows.
Because the business is inherently stable, you need a slightly smaller margin of error.
The utility isn't going to suddenly see its revenue drop by 60% overnight. But an industrial company is a totally different animal.
Taking your point further, an industrial company operates in a fiercely competitive, cyclical, unpredictable environment.
Yeah.
They deal with inventory gluts, fluctuating raw material costs, changing consumer tastes, and labor strikes. The earnings of an industrial company can swing wildly from year to year.
So the more variable the underlying enterprise, the higher the margin of safety you must demand to ensure your fixed dividend can survive the bottom of the cycle.
That makes perfect sense. The instrument matters, of course, but the business foundation comes first.
A weak, highly cyclical business does not miraculously become a sound sleep-at-night investment just because the board of directors decides to issue a preferred stock instead of a common stock.
Exactly.
Yeah.
You can't fix a shaky foundation by painting the front door a different color.
That is the exact trap Graham and Dodd are pointing out. And there's a very subtle, almost philosophical point in the chapter regarding how strict these thresholds actually are.
The authors readily admit that these margins of safety, like demanding 4 times coverage for an industrial preferred man, might seem unreasonably high to the average investor or the average Wall Street broker.
Right.
They even admit that if investors had strictly applied these exact standards, it would have disqualified a massive amount of the preferred stock financing that was issued and sold to the public before 1931.
If I'm an investor in 1929 looking at a 4-times standard, I'd probably think, this is way too strict. If I follow this rule, I'm going to miss out on all these great yields.
Wall Street would definitely complain that these rules would have killed half their underwriting business.
And Wall Street did complain. But Graham and Dodd lean entirely into that criticism. They add a deeply important sentence to the text. They state that this severity would have benefited the investing public.
Benefited the public. So they're saying, yes, our rules would have stopped you from buying all those securities, and you would have been vastly richer for it when the crash came.
Precisely. If the standards feel stringent, that is not a defect of the standards. It is a feature.
It is exactly the discipline that investors desperately needed to avoid catastrophic, permanent, losses of capital.
This is a timeless point that applies to every single economic cycle.
Yeah. During the boom times, discipline standards always sound too strict. People call you old-fashioned. They say you are missing out on the easiest yield in the market.
And then, inevitably, a downturn arrives. The weak companies pass their dividends, the stock prices collapse, and suddenly those strict standards look incredibly sensible again.
It's like wearing a seatbelt. It feels restrictive and somewhat unnecessary while you're just cruising down the highway on a sunny day.
Right. But the moment the brakes lock up and you hit a patch of ice, you realize the restriction was the only thing keeping you from going through the windshield.
Perfect analogy.
Now, do they ever allow for these rules to be relaxed? Are these multiples etched in stone forever?
They do allow a theoretical exception. They write that if we entered a genuinely, permanently more stable economic world, that might justify some leniency in the coverage ratios later on. But, and this is key, until that stability is conclusively proved over a very long period of time, they want investors to remain extremely exacting.
Is it a fantastic mental model well beyond just preferred stocks?
Yeah.
Assume instability until stability is proven, not the other way around.
Okay, so we have established that strict coverage multiples are absolutely required. 2 times for utilities, 2.5 times for railroads, 4 times for industrials.
But having the strict multiple is only half the battle. Now we have to address how to actually calculate that multiple.
And here is where the text gets incredibly revealing, because this is where investors mathematically deceive themselves. Let's talk about the big analytical trap of the chapter.
This is perhaps the most vital mechanical lesson in the entire text, because the chapter moves from general principles of safety to actual mathematical technique.
Graham and Dodd are warning you. Even if you think you are being an analytical, rigorous investor by looking at coverage ratios, your underlying method of calculation might still be fundamentally flawed.
You might be lying to yourself with accurate numbers.
I'll introduce the fallacy because it's brilliant in its deception. The most common error investors make is calculating and stating the earnings on the preferred stock in total isolation.
In total isolation?
Yes. They look at the preferred stock, they look at the earnings left over after the senior bond issuance has been paid, and they express the preferred coverage separately, very often in dollars per share.
They completely ignore the massive mountain of bonds that sit ahead of them in the capital structure.
That is the fallacy of isolation. And here is the correct method, which Graham and Dodd call the total deductions method.
Let's hear it.
If bonds exist in the capital structure ahead of the preferred stock, you absolutely must combine the bond interest requirement and the preferred dividend requirement together into one total sum.
So you lump them together.
Exactly. The question you have to ask is not, how well does the leftover pool of money cover this tiny preferred issue?
The correct question is, how well do the total earnings cover all prior and equal claims together?
Let's build a household analogy here to make sure this is crystal clear for you because the math can get abstract.
Good idea.
Imagine a family budget. Let's say a family brings in a total income of $10,000 a month. They have a massive home mortgage. That's the bond. The mortgage payment is $8,000 a month.
That leaves $2,000 of leftover money.
Now, they go out and lease a fancy sports car. That's the preferred stock. The car payment is $200 a month.
Okay, taking your mortgage analogy a step further, let's look at how the fallacy of isolation processes those numbers.
Right. If we use the wrong method, the fallacy of isolation, the investor looks at that $2,000 of leftover money, looks at the $200 car payment and says, wow, the car payment is covered 10 times over. 2,000 divided by 200 is 10. This is an incredibly safe car loan.
But they're completely ignoring the $8,000 elephant in the room.
Because if that family's income drops by just 20% from $10,000 down to $8,000, that leftover $2,000 completely vanishes.
The mortgage, which is the senior claim, consumes every single penny. The car loan defaults immediately.
The 10 times coverage was a complete mathematical illusion created by isolating the junior claim.
It's an illusion created by ignoring the structure of the waterfall. The cash flow comes from the top down. The mortgage bucket gets filled up first. If there's an income drought, the water never even reaches the car payment bucket.
Exactly.
So how does the total deductions method fix this deception?
Using your exact numbers, the total deductions method forces you to add the mortgage and the car payment together.
So $8,000 for the mortgage plus $200 for the car equals $8,200 in total fixed charges.
Right. Then you compare the total family income, $10,000, to that combined burden of $8,200. 10,000 divided by 8,200 is roughly 1.2 times coverage.
Which tells a completely radically different story.
It really does.
1.2 times coverage means the family is living right on the edge. A tiny hiccup in their income, a couple of missed shifts at work, and they are totally underwater.
But the wrong method told us they had 10 times coverage.
It's wild how the exact same underlying economic reality can be manipulated to look like an impenetrable fortress just by changing the numerator and the denominator.
And Graham and Dodd are unsparing in their critique of this practice. They highlight the absolute logical absurdity of it.
If you use the wrong method, isolating the preferred earnings, you inevitably create a mathematical illusion where a junior preferred dividend appears to be significantly safer than the senior bond interest of the exact same company.
Wait, I really want to emphasize that. You end up with a junior claim that looks safer than the senior claim sitting ahead of it?
Which is logically impossible.
Right. If the senior claim fails, the junior claim is automatically wiped out. To claim the preferred is safer than the bond is absurd.
It is absurd. And yet, this was the standard accepted way these securities were marketed to the public.
To prove just how dangerous this illusion is, Graham and Dodd walk the reader through 3 concrete historical case studies.
And we really need to walk through the math on these slowly, comparing the wrong method with the right method for maximum clarity. Because once you see this arithmetic play out in the real world, you will never look at a corporate earnings release the same way again.
Let's do it. I want to linger on the math here. We will speak the numbers out fully so you can really conceptualize the scale of the deception. Let's start with case 1, Colorado Fuel and Iron, using their actual reported figures from the year 1929.
All right. Let's look at the raw facts for Colorado Fuel and Iron in 1929. The company had total earnings available for fixed charges of $3,978,000.
Let's call that roughly $4 million. That is our total pool of money.
Now, the company had interest charges on its senior bonds of $1,628,000.
Beneath those bonds, it had preferred dividends owed of $160,000.
Okay, so roughly $4 million in earnings, about $1.6 million owed to the bonds, and a tiny $160,000 owed to the preferred. Let's look at the deception first, the customary incorrect reporting method.
They would take the total pool, $3,978,000, and divide it by the interest charges of $1,628,000.
That gives us interest coverage of 2.4 times.
Then they take the leftover money and divide it by the tiny preferred dividend requirement. Under this wrong method, they proudly claim to the public that the preferred dividend was earned a massive 14.7 times.
They would even express it as earning $117.50 per share of preferred stock.
Think about the psychological impact of reading that in a newspaper in 1929. Our senior bonds are covered 2.4 times, but our preferred stock is covered 14.7 times.
It sounds wonderful for the preferred holder. It sounds like you were sitting on an impenetrable vault of cash.
But wait, 14.7 times? That sounds like a fortress. If I'm an investor, I'm thinking I can put this in my bottom drawer and forget about it.
Let's do the reality check using the right method, the total deductions method.
Under the total deductions method, you must add the prior claims and the preferred claim together to find your true burden. So we take the interest charges of $1,628,000 and we add the preferred dividends of $160,000.
That gives us a total combined burden of $1,788,000.
And then we divide the total available earnings, $3,978,000, by that newly combined burden of $1,788,000.
Exactly. And when you perform that division, you find that the combined coverage is only about 2.2 times.
Wow. So it drops from 14.7 times down to 2.2 times.
The reality is 2.2 times.
Yeah.
A modest reality, completely disguised as a fortress of 14.7 times.
And 2.2 times is not extraordinary safety. For an industrial company like a fuel and iron business, remember, Graham and Dodd wanted 4 times coverage.
So this preferred stock was actually woefully underprotected according to their strict standards, but the faulty math made it look like the safest security on earth.
The wrong method turns a modestly covered, perhaps even dangerously exposed claim into something that sounds bulletproof. It isolates the tiny junior claim and totally ignores the massive debt burden sitting right on top of it, casting a shadow over everything.
Let's look at case 2, which is Warner Bros. The figures here are for the year ended August 28, 1937. What were the exact numbers?
For that year, Warner Bros. Had available total earnings of $10,760,000. Their interest charges on debt were $4,574,000.
Okay.
Their preferred dividend requirement was much smaller, at $397,000.
Okay, here comes the deception again. The customary method isolates that tiny $397,000 dividend against the millions in leftover earnings.
By doing that, the company claimed the preferred dividend was earned 14.8 times. They translated that to an impressive-sounding $56.99 per share. Again, it sounds phenomenal.
But again, it is completely misleading. Let's apply the correct total deductions math. We add the interest of $4,574,000 to the preferred dividends of $397,000.
That gives a total combined burden of $4,971,000, roughly $5 million in total burden against roughly $10.7 million in earnings.
Then we take the available pool of $10,760,000 and divide it by the total burden of $4,971,000. And what do we get?
The combined coverage was merely about 2.1 times.
So the proper reading of the situation is not the preferred stock is swimming in an ocean of earnings covered almost 15 times over.
Right. The proper sober reading is this entertainment company is covering its total senior burden by just a bit more than 2 times. That is a massive difference in interpretation.
It fundamentally changes your understanding of the risk you are taking. Graham and Dodd are essentially grabbing the investor by the shoulders and telling you, once bonds exist ahead of the preferred stock, you absolutely cannot isolate the preferred.
You cannot pretend it lives in its own little detached world. It doesn't. Its fate is inextricably tied to the massive debt sitting above it.
I want to move to case 3, because this is the most dramatic example in the entire chapter. This is the Penn Electric Company.
Oh, this one is wild.
And the reason this one is so incredibly dangerous is because it involves a capital structure with multiple layers of preferred stock. It shows you the specific danger of second preferreds.
Yes, Penn's Class A stock was, in economic reality, a second preferred issue. It sat beneath both bonds and a layer of senior preferred stock.
Let's look at the stack of claims here. The company had net earnings before charges of $13,604,000.
Their fixed charges, which included things like interest and preferred dividends of subsidiaries, were $8,113,000.
Okay, so let's conceptualize that. That's the first big chunk of the waterfall. $8.1 million out of a total $13.6 million.
Correct. Below that massive fixed charge, they had a layer of 7% and 6% senior preferred issues. The dividend requirement for those senior preferreds was $2,267,000.
So that's layer 2 in the waterfall.
Finally, below that was the Class A stock, the second preferred. The dividend requirement for this junior issue was just $412,000.
Okay, let's walk through how this was deceptively presented to the public. Using the wrong method of isolation, they calculated each layer sequentially against whatever was left over.
So they said the fixed charges were earned 1.68 times.
Then they looked at the leftover money, isolated the senior preferreds, and said they were covered 2.42 times.
Then they looked at the tiny remainder, isolated the Class A stock, and claimed it was covered an incredible 7.43 times. They reported it as earning $54.79 per share.
This is where the absurdity reaches its absolute peak. According to this presentation, the fixed charges, the most senior, legally enforceable claim at the top of the stack, are supposedly the riskiest, at only 1.68 times coverage.
Right. And the Class A stock, the most junior, unprotected, second-tier preferred claim at the bottom, looks incredibly safe at 7.43 times coverage.
It completely inverts reality. It makes the weakest security look like the strongest.
It's mathematically hallucinating.
Yeah.
To claim the junior is safer than the senior. Absurd. Let's bring reality back. Let's cascade down the waterfall using the right method, calculating combined coverage at every single step, carrying the entire burden down with us.
We start with the total earnings pool, $13,604,000.
Step 1. Fixed charges alone. $13,604,000 divided by $8,113,000. The coverage is 1.68 times.
Step 2. Fixed charges plus the senior preferreds. We add the $8,113,000 to the $2,267,000. That combined burden is $10,380,000.
Now divide the total earnings by that combined burden, $13,604,000 divided by $10,380,000. The coverage drops to 1.31 times.
Step 3. The total burden down to the Class A stock. We take the $10,380,000 and add the Class A dividend of $412,000. The total combined burden is now $10,792,000.
Divide the total earnings of $13,604,000 by the total burden of $10,792,000. The true combined coverage for the Class A stock is only 1.26 times.
Wow. So the illusion presented to the public was 7.43 times. The reality was a dangerously thin 1.26 times.
The coverage didn't magically go up as you moved down the capital structure. It cascaded down exactly as logic and gravity dictate it should.
Fixed alone was 1.68x, plus senior preferreds it fell to 1.31x, plus Class A it fell to a razor-thin 1.26x.
And this was not just a textbook quibble for Graham and Dodd. This affected real money. People bought that Class A stock believing it had 7 times coverage. They thought they were buying a conservative sleep-at-night investment.
In reality, they were buying a highly leveraged sliver of equity masquerading as a bond.
This is why the chapter still matters so much today. The mechanics of the deception haven't changed.
So, if we synthesize this into a simple unbreakable rule for you, if you are testing a preferred stock that has senior obligations ahead of it, like bonds, you should never ask, how large is the leftover pool, when expressed on my tiny issue alone.
You must always ask, how many times are all the claims ahead of me, plus my own claim, covered by total earnings?
That is the total deductions rule in plain English.
Okay, but this brings us to a really fascinating, seemingly logical pushback based on the math we just did. Because we just proved that as you add claims together, the combined coverage ratio will always go down.
So someone might be thinking, if combined coverage of bond interest plus preferred dividends is inevitably, mathematically always lower than the coverage of bond interest alone, shouldn't preferred stocks be allowed a lower minimum standard? Shouldn't they be graded on a curve?
It is a very natural question to ask. If the math is inherently harder to pass, shouldn't the test be relaxed? And Graham and Dodd's response is an absolute definitive no. That conclusion is entirely false.
Why? If the combined ratio is always smaller by definition, why demand a stricter standard?
Because the preferred stock does not deserve a looser test just because its arithmetic is harder. It deserves a stricter test because its legal position is weaker. The correct interpretation is this. A preferred stock can be considered sound only when the bond position ahead of it is vastly safer than its required minimum.
Let me make sure I understand that. You're saying that if the bonds are merely safe enough, meaning they just barely pass their own 3x or 2x coverage test, then the preferred stock sitting below them is automatically unsound.
Exactly. For the preferred to be genuinely safe, the enterprise must be so economically strong and generating so much cash flow that even when you combine the bond interest and the preferred dividend, that larger combined burden still comfortably clears a demanding minimum.
I see. It's not about giving the preferred stock a break. It's about demanding that the company as a whole is a financial powerhouse. Let's look at the two examples the chapter gives to illustrate this point. Liggett and Myers Tobacco, compared to Commonwealth and Southern. Both cases are from the year 1930. Let's start with Liggett-Myers.
In 1930, Liggett and Myers had fixed interest charges that were earned an astonishing 15.2 times. Now, when you applied the total deductions method and added their preferred dividend requirements, the combined coverage dropped to 7.87 times.
So the ratio dropped by almost half. But 7.87 times is still incredibly high.
Keep in mind, Graham and Dodd suggested minimum for industrial preferreds. It was 4 times. So even on a combined basis, Liggett and Myers was generating 7.87 times coverage. It was far, far above the minimum.
The bonds weren't just safe. They were significantly safer than necessary.
And because the enterprise was generating so much excess coverage, that left plenty of room for the preferred stock to be genuinely, fundamentally sound.
Okay, now let's contrast that with Commonwealth and Southern in 1930.
For Commonwealth and Southern, their fixed charges alone were covered only 1.84 times. When you applied the total deductions method and added the preferred dividend, the combined coverage fell to 1.48 times.
So their fixed charges at 1.84 times. If this was a utility company, that might actually scrape by as acceptable for a bond since the utility bond minimum was 1.75 times.
Right.
The bonds might just barely qualify as investment grade. But what about the preferred?
The combined coverage was 1.48 times. The required minimum for a utility preferred, according to Graham and Dodd, is 2 times. 1.48 is nowhere near 2.
So while the bonds might scrape by, the preferred stock could not possibly qualify as a sound investment.
And here's where Graham and Dodd deliver a truly brutal assessment. They state that buying that 6% Commonwealth and Southern preferred stock above par in 1930 was an obvious, mathematically visible mistake before the crash.
That is a chilling point. Visible before the crash. They were saying you didn't need a crystal ball to know this was a bad investment. You didn't need to foresee the Great Depression. You just needed to do the arithmetic.
Good security analysis is not about relying on hindsight. It is about ante-judgment, judgment made before the fact, grounded entirely in the capital structure and the raw arithmetic of coverage. If the math fails the test, you walk away, regardless of how popular the security is.
This connects directly to another analytical trap they discuss, which is the dollars per share deception. We touched on this earlier, how companies love to report that a preferred stock earned $56 a share to make it sound incredibly safe.
Right.
But Graham and Dodd say that even when a preferred stock has no bonds ahead of it at all, even when there is no senior debt, expressing earnings in dollars per share is still a terrible habit. Why is dollars per share a bad metric, even in a simple capital structure?
They give two distinct reasons. The first is behavioral conditioning. If you get used to quoting preferred earnings in dollars per share when a company has no debt, you are highly likely to keep using that same metric when you analyze a company that does have debt.
And as we just proved with Colorado Fuel and Iron and West Penn Electric, using dollars per share when bonds exist is mathematically dangerous. It trains you to use a flawed tool.
It's like learning to measure distance by counting your footsteps. It might work fine in your living room, but if you try to use it to survey a mountain, you're going to fall off a cliff.
What is the second reason?
The second reason is that raw dollars do not translate well across different securities because par values and market prices vary wildly. They use the example of SH Crest to explain this.
Oh, I like this example.
Imagine a company that earns $20 per share on its preferred stock. Sounds great, right? But what if that preferred stock has a par value of $100 and it pays a 7% dividend?
Earning $20 on a $100 par value is decent, but it's fundamentally different from earning $18.60 on a 6% preferred stock that has a par value of only $10.
Let me unpack that. Earning $18.60 on a share that only requires a 60-cent dividend, which is 6% of a $10 par value, means the dividend is covered an astronomical number of times. It's covered 31 times.
But earning $20 on a share that requires a $7 dividend, which is 7% of a $100 par value, means the dividend is covered less than 3 times.
If you only look at the raw dollars 1860 versus 20, you might think the $20 earner is safer. But relative to the actual dividend requirement, the 1860 earner is vastly superior.
Raw dollars per share strip away the context of the liability. $20 earned per share is also very different depending on the market price.
Exactly. If the stock trades at $80, $20 in earnings is a 25% earnings yield. If the stock trades at $125, that same $20 is only a 16% earnings yield.
The dollars don't mean anything without the context of the requirement and the price. So Graham and Dodd are pushing us entirely away from these cosmetic raw dollar reporting metrics and toward comparable measures. Times dividend requirements earned, combined coverage, ratios that actually preserve the economic meaning of the safety.
You want ratios that measure the cushion of safety, not absolute numbers that just sound impressive in a vacuum.
Which is the perfect transition to the second major technical test in the chapter. Earnings coverage proves that the income stream is safe. It tells us the company's making enough cash to pay the bills right now.
But what happens if things go wrong? What happens if the earnings temporarily collapse during a recession?
That is where we need to look at the asset cushion beneath the claim. This brings us to the stock value ratio.
If the earnings coverage is the shield, the stock value ratio is the safety net beneath the tightrope walker. This test asks a very simple question. How much junior market value sits behind or beneath the senior claim you are evaluating?
Meaning, how much value has to be completely wiped out by the market before my claim takes a single penny of loss?
It measures the buffer. Now, the books table on this can sound a bit awkward, but the economic rule of thumb is very straightforward. It mirrors the earnings coverage logic.
Public utility preferreds need the lightest junior stock cushion. Railroad preferreds need something around a 1-for-1 cushion, and industrial preferreds require the heaviest, largest junior stock cushion of all three.
Because again, utilities are the most stable and industrials are the most volatile, so you need a bigger shock absorber for the industrial company.
Let's walk through how an investor actually calculates this ratio, because Graham and Dodd provide a brilliant step-by-step case study using Procter Gamble from its 1932 low.
This is a perfect example to illustrate the mechanics. We are going to look at Procter & Gamble's capital stack, starting from the most senior claim at the top down to the most junior at the bottom. At the very top, they had bonds with a face amount of $10.5 million.
Okay, bonds. $10.5 million.
Right below the bonds, they had a first preferred stock, an 8% issue. The low 1932 market value for this entire issue was $3,150,000.
First preferred. $3.15 million.
Below that, they had a second preferred stock, a 5% issue. The low 1932 market value for this layer was $13,900,000.
Second preferred. $13.9 million.
And finally, at the bottom, the common stock. The common had a low 1932 market value of $128,200,000.
So the common, $128.2 million. That is a massive common cushion compared to the senior debt.
It is remarkably strong. Now let's calculate the stock value ratio for each layer of this capital structure. The rule is parallel to the total deductions method for earnings. You always compare the total combined senior claims to all the junior value that sits subordinate to them.
The direction of thought is always, what value is totally subordinate to the claim I am examining? Let's start with the safest folks, the bond holders at the top.
For the bonds, the claim is $10.5 million. What sits beneath them? Everything else. The common stock, the second preferred, and the first preferred.
So we add those up, 128.2 million plus 13.9 million plus 3.15 million. That gives us about $145.25 million in total junior value.
Wait, let me make sure I'm following. So essentially, we divide that massive 145.25 million junior cushion by the 10.5 million bond claim.
And that works out to a ratio of about 13.8 to 1. For every dollar of bond debt, there was nearly $14 of equity value beneath it that would have to be wiped out before the bonds were impaired.
Incredible safety. Now let's move down one rung on the ladder to the first preferred stock.
When testing the first preferred, we must combine its value with the bonds ahead of it. So the total senior claim is the $10.5 million in bonds plus the $3.15 million first preferred, giving a senior burden of $13.65 million.
Now what sits subordinate to this first preferred? Only the second preferred and the common stock.
So we add the $128.2 million common to the $13.9 million second preferred. That's a junior cushion of $142.1 million.
Divide the $142.1 million junior cushion by the $13.65 million senior burden, and you get a stock value ratio of about 10.4 to 1.
Still an incredibly robust cushion. Now let's drop to the next layer, the second preferred.
For the second preferred, the total senior burden now includes the bonds, the first preferred, and the second preferred itself. So $10.5 million plus $3.15 million plus $13.9 million equals a combined senior claim of $27.55 million.
And what sits beneath the second preferred?
Only the common stock, just the $128.2 million.
So we divide the $128.2 million common value by the $27.55 million total senior claim. The ratio falls to about 4.6 to 1.
Which is a beautiful illustration of how risk works. It's a descending ladder of protection. As you move down the capital structure from bonds to first preferred to second preferred, the protective cushion shrinks.
13.8 to 1, down to 10.4 to 1, down to 4.6 to 1. The math perfectly reflects the economic reality of who takes the hit first.
That is precisely how the stock value ratio should illuminate the structure for an investor.
I do want to clarify one detail they mention about this calculation. Should an investor compare the common stock's market value to the par value of the preferred stock or to the preferred stock's market value?
Graham and Dodd say that in most cases, it won't make a life-or-death difference. However, because there are many no-par preferreds, and because some stated par values are completely artificial and do not reflect the real economic claim, they strongly recommend regularly using the market price of preferred stocks when computing this ratio.
Because market price captures the economic reality of what the market thinks that claim is worth, whereas par value might just be a legal fiction invented by a lawyer 20 years ago.
The goal of security analysis is economic reality, not clerical neatness. Now, for bonds, they actually do recommend using the face value rather than market value. Mostly because a bond represents a hard, fixed contractual repayment amount, so using face value is more convenient and avoids the complications of fluctuating interest rates changing the bond's price. But for preferreds, stick to market value.
Okay, so we have mathematically tested the earnings coverage, and we have mathematically tested the equity cushion. We've done the arithmetic.
But Graham and Dodd don't stop there. Having tested the math, we must now test the legal structure of the instrument itself.
And this brings us to a specific governance flaw that essentially transfers power away from the investor. Let's talk about the danger of non-cumulative preferred stocks.
This is one of the most interesting sections of the chapter because it blends quantitative analysis with corporate governance. We need to clearly define the difference between a cumulative preferred stock and a non-cumulative preferred stock.
I'll start with cumulative because that's what most people assume they are buying. If a preferred stock is cumulative, it means that if the company hits a rough patch and skips your dividend payment, that unpaid amount goes into a bucket.
It accumulates.
And generally, the company must pay you every single cent in that bucket before they are legally allowed to pay any dividends to the common stockholders again. Your claim isn't erased, it's just delayed.
But a non-cumulative preferred stock is entirely different. If the company omits the dividend in a given year, it is usually just gone forever. Poof.
The holder cannot claim it later merely because the company eventually recovers and could have easily paid it. It does not go into a bucket, it is simply erased.
But wait, if a company is earning 16 times its dividend, why should I care if the contract is non-cumulative? The cash is obviously there. Aren't you just splitting legal hairs? If they have the money, they'll pay it, right?
That is the exact assumption that gets investors hurt, because it ignores the profound conflict of interest in the boardroom.
Let's look at the mechanism of management incentives. Who decides whether to pay that dividend? A board of directors. And who do the directors represent?
The common stockholders.
Exactly. The directors usually hold common stock themselves. If they pass a non-cumulative preferred dividend, that money doesn't disappear. It stays inside the company. It plumps up the retained earnings, which ultimately increases the value of the common equity.
So there's a direct financial incentive for the CEO to starve the preferred shareholder.
There is a massive incentive. Graham and Dodd state bluntly that this arrangement is so deeply inequitable that new buyers historically objected to it. For many years, new offerings of straight preferred stock almost always included the cumulative feature to attract buyers.
They point out that non-cumulative issues often arose out of bankruptcies and reorganizations, where the old, distressed security holders were essentially forced to accept whatever terms they were given.
So the non-cumulative language isn't just a quirky legal phrase. It represents a massive transfer of power toward the management team and away from the provider of capital. It allows directors to withhold dividends even in highly prosperous years when they are amply earned.
They note that experience overwhelmingly shows that non-cumulative dividends are seldom paid unless management also wants to declare a dividend on the common stock.
So the preferred holder's income ceases to be a matter of the company's ability to pay and becomes entirely a matter of management choice.
The St. Louis-San Francisco Railway example in the text makes this agency problem incredibly concrete. What happened there?
It is a stark illustration. Graham and Dodd note that no dividends whatsoever were paid on the old preferred stock of the St. Louis-San Francisco Railway between the years 1916 and 1924.
An 8-year drought. But were they losing money during those 8 years?
No. The dividend was fully earned in most of those years. The company had the earning power to pay it, but because it was non-cumulative, management simply chose not to. And the payments were not magically resumed until just before dividends were initiated on the common stock.
Oh, how incredibly convenient. We won't pay you for 8 years while we hoard cash, but the moment we want to pay ourselves a common dividend, suddenly we find the checkbook.
It gets worse. On the newly issued preferred stock later on, the payments continued for less than a year after the common dividend was suspended in 1931, which proves beyond a shadow of a doubt that earning power alone was not the decision rule. Management policy and self-interest was the decision rule.
That is infuriating from an investor's perspective. You're taking equity-like risk with the dividend, but you have a fixed upside. What does the law actually say about a company holding back earned money from a non-cumulative preferred?
The chapter briefly mentions two legal cases that point in opposite directions, showing the tension here. In New Jersey, the United States cast iron pipe case effectively ruled that earned but unpaid non-cumulative dividends were treated as owing, meaning they had to be made good before the common could receive anything. The court basically tried to enforce fairness based on earnings.
Okay, so the New Jersey court tried to create a bucket for the unpaid dividends if they were genuinely earned.
But the Supreme Court in the Wabash Railway case went the exact opposite direction. The Supreme Court held that however harsh the term may be, the holder accepted the non-cumulative contract when they bought the issue. The company owes them nothing.
Which highlights a profound lesson. Legal validity and investor fairness are not the same thing. Something can be 100% legal and 100% terrible for you as an investor.
Graham and Dodd accept the reality of the Supreme Court law, but they still argue fiercely that the provision is so inherently bad that legislatures should step in and require earned but unpaid dividends to accumulate by statute. But until that happens, the investor must protect themselves. A non-cumulative preferred might look perfectly acceptable during a prosperous boom period, but the provision inherently creates room for unfair policies by directors during any period of stress. That is the structural flaw. It adds discretion exactly where the fixed income investor wants rigid obligation.
So we've outlined the math, earnings coverage, total deductions, stock value ratios. We've outlined the structural flaw, the danger of non-cumulative dividends, and management discretion. A listener might be tempted at this point to create a very rigid black and white set of rules. I will never buy a non-cumulative preferred. I will never buy a preferred that has bonds ahead of it. But here is where Graham and Dodd throw a fascinating curveball. They warn against becoming completely mechanical. When does substance overwhelm form?
This is a beautiful pivot in the chapter. Because after spending pages detailing all the reasons to avoid non-cumulative preferreds and issues with prior debt, they point out a surprising fact. Among the 21 preferred stocks that they themselves regarded as continuously investment grade throughout the severe 1932 test, 4 of them were actually non-cumulative.
I have to admit that sounds totally contradictory. They just spent an entire section explaining how dangerous non-cumulative preferreds are, how management will exploit you, and yet nearly 20% of their survivor list in the worst depression in history were non-cumulative issues.
And they explicitly reject the idea that this statistical anomaly proves non-cumulative issues are somehow secretly superior. That is not the lesson. Their point is far more profound. Form, title, and legal rights matter, but they matter significantly less than the actual overwhelming economic exhibit made by the individual company.
It's a classic Graham and Dodd refusal to think strictly by category alone. They refuse to be dogmatic if the numbers tell a different story.
If you look at that list of 21 strongest preferred issues, non-cumulative issues and issues preceded by bonds were both more heavily represented there than in the broader market list. One of the strongest issues was a second preferred. One of them had a bizarre $1 par value. One was callable near its low price.
By every structural rule we just discussed, those issues sound terribly flawed.
They are structurally flawed. But the lesson is not to go out and buy non-cumulative second-tier preferreds with weird par values. The lesson is that seemingly unfavorable legal form can be completely neutralized by overwhelming sheer economic strength. Just as seemingly favorable legal form, a beautifully drafted cumulative contract can be easily overwhelmed by weak underlying business substance.
Substance over form. Let's sit with the example of United States tobacco to prove this, because it shows why a structural flaw becomes practically irrelevant when the math is just obscenely good.
It is a perfect example. Graham and Dodd note that United States Tobacco Company preferred was a non-cumulative issue. By rule, a dangerous structure. But let's look at the substance. Its dividend was earned more than 16 times over in the Deep Depression year of 1931.
16 times coverage in the middle of the Great Depression.
And on top of that, the company possessed so much excess cash and strength that they were actively willing to buy back a large part of the preferred issue in the open market at prices up to $125 per share.
So if you hold that non-cumulative preferred, do you care about the structural flaw? No. The company is generating 16 times coverage and aggressively buying back the stock at a massive premium. The economic protection is so enormous that the legal imperfection of the non-cumulative clause barely even registers in reality.
The strength of the business neutralized the weakness of the contract. However, the authors immediately caution the reader that this level of strength is highly exceptional. As a matter of practical, everyday policy, they still strongly recommend choosing a cumulative issue whenever you reasonably can.
Which is a very wise, balanced framing. Overwhelming strength can neutralize a flaw, but as an investor, you shouldn't actively go out searching for flaws hoping they get neutralized. You should prefer the stronger contract unless facts are so undeniably overwhelming that they justify an exception.
And they reinforce this warning by showing the flip side. When favorable form is destroyed by weak substance, they use the record of American Car and Foundry's 7% non-cumulative preferred.
What happened there?
This stock had an apparently splendid history. For many years, American Car and Foundry's preferred actually sold at a higher price than United States Tobacco's non-cumulative preferred. It had completed decades of uninterrupted, smooth dividend payments. For years, its market price had never fallen below par. It looked like a permanent fixture of stability.
A completely unblemished past.
But in 1932, the business reality caught up. The dividend was past meaning omitted, and the market quotation of the stock violently collapsed down to 16.
Down to 16. From trading above par for years, down to 16. So a long, smooth historical record is helpful, but it is not a substitute for structural analysis. Past stability isn't a magical shield that guarantees a self-correcting future if the underlying business deteriorates.
The long-term investor must judge stability in relation to the current business and the capital structure, not merely the recent payment history.
I want to touch on how this substance over form idea applies to the presence of funded debt. Because earlier, we emphasized how dangerous it is when a preferred stock has bonds ahead of it. We spent half the conversation on the total deductions trap. So should an investor just categorically reject any preferred stock that has bonds senior to it?
Graham and Dodd say absolutely not. They explicitly warn against making that a rigid automatic rule. They call that kind of rule hard and fast in a bad sense. Now, obviously, it is desirable for a preferred issue to have no funded debt ahead of it. To use a real estate analogy, it is always better to hold a first mortgage on a property rather than a second mortgage.
Right, being at the top of the waterfall is always the goal.
But it does not logically follow that every preferred stock with bonds ahead of it is automatically unsound. In fact, they point out that if you rigidly applied a no prior debt rule, you would be forced to reject virtually all public utility prefers because utility companies almost always utilize bond financing ahead of their preferred stock.
And yet, public utility preferreds as a class were generally regarded as much safer than industrial preferreds, which often had no debt at all.
Furthermore, they note that in the absolute extreme test of the 1932 market bottom, a very substantial percentage of the preferred issues that successfully held up and maintained their investment status were, in fact, preceded by funded debt. So again, the mere presence of debt is not the decisive factor. The amount of the prior debt, combined with the strength of the company supporting it, is what dictates safety.
They used the General Electric preferred stock in 1933 as a vivid illustration of this. Tell us about the GE example.
General Electric had a tiny, almost infinitesimal bond issue sitting in its capital structure ahead of its preferred stock. Graham and Dodd argue that to automatically reject the General Electric preferred stock, which was backed by an absolute juggernaut of an industrial company, simply because a microscopic amount of debt happened to sit senior to it, would have been completely absurd.
Okay, so the practical takeaway for you here is nuanced. The presence of bonds ahead of a preferred stock should make you more cautious, but not automatically dismissive. It increases the burden on your analysis. It forces you to use the total deductions method, but it does not eliminate the need for the analysis by letting you lazily throw the stock in the reject pile based on a category.
Categories are not analysis. They are prompts for analysis. The analyst must look at the specific facts. How much prior debt is there? How safely is the combined burden covered? What does the junior market cushion look like? How inherently stable is the business? Does management have the latitude to withhold dividends? All of that specific localized detail matters vastly more than a simplistic black and white rule.
There's a part of this section that I really enjoy because it feels like Graham and Dodd are winking at the reader. It's almost humorous. When they were looking at their favorite list of strong preferred stocks that survived 1932, they noted that 3 of the non-cumulative industrial preferreds on that list belonged to snuff companies, smokeless tobacco. And they used that quirky little fact to teach a really profound lesson about personal taste.
They clarify that this concentration of snuff companies is interesting not because it proves the overarching investment primacy of snuff. They use it to remind the investor of a very strict psychological boundary. You must not judge the merits of a fixed value security by your personal emotional reaction to the kind of business involved.
Which is a lesson modern investors desperately need to hear. People love investing in stories that align with their personal tastes. They like buying products they admire, technologies they use in their daily lives, brands they find socially noble, or industries they just think are exciting and glamorous.
But the security contract does not care whether you find the underlying business glamorous. The arithmetic of coverage does not care about your personal aesthetic preferences. Graham and Dodd state that for a fixed value investment, like a bond or a preferred stock, the only sound basis available is usually an outstanding long-term record, strong evidence of inherent business stability, and no concrete reason to expect a substantial change for the worse.
That is an extraordinarily sober standard. No concrete reason to expect a change for the worse. It is completely devoid of hype.
And it is deeply refreshing because it forces the investor entirely away from fashion, away from market fads, and focuses them entirely toward durability.
Which is exactly where anyone buying a preferred stock ought to live. If you are buying a fixed claim security, your upside is capped. You are not going to get rich off the growth of the company. So you are not signing up for romance, you are signing up for reliability. If the most reliable company happens to make snuff or industrial pipe or something incredibly boring, that is where your money belongs. Okay, let's step back and synthesize this entire technical discussion. We've gone deep into the arithmetic and the legal structures. I wanted to build a usable, real-world framework for you listening. Suppose someone wants to carry forward the absolute best of Chapter 15, even if they never buy an individual preferred stock in their life. What are the core questions they need to ask before calling a security an investment rather than just an income speculation? Let's build a checklist together. I'll start with the obvious one: the business itself.
That is always step one. Analyze the business stability first. You cannot analyze the security without analyzing the company underneath it. Is the enterprise a utility, a railroad, or an industrial? Is it stable enough to support a fixed, mandatory cash claim through a full economic cycle?
And from there, the second check has to be the earnings coverage, right? Not just looking at the last 12 months during a boom, but measuring the average over a cycle. And crucially, if bonds sit ahead of the preferred stock, you must use the total deductions method.
Right. You combine the bond interest plus the preferred dividend requirement together as one massive hurdle. That leads to the third check. Comparing that combined result against strict minimums. 2 times coverage for utility preferreds, 2.5 times for railroads, and 4 times for industrial preferreds. And remember, the principle of demanding a wide margin of safety matters even more than memorizing the exact decimal points.
And the fourth point, if earnings are the shield, we need to check the safety net, the market value equity cushion beneath the claim. We have to ask how much junior market value, the common stock and any junior preferreds, truly stands subordinate to the security we are buying. A thin or highly volatile common stock cushion is not real protection.
The fifth consideration is about debt. Evaluate the actual amount of prior debt, not just whether any exists. A tiny trivial residue of old bonds is a very different analytical situation than a massive, heavy senior debt burden hanging over the company.
And the sixth check has to be the legal structure. We should strongly prefer cumulative dividend structures to non-cumulative structures, unless the economic strength of the business is absolutely overwhelming. Because if you accept a non-cumulative provision, you're giving management entirely too much room to disappoint you.
The seventh point is about metrics. Completely ignore cosmetic, raw dollars per share metrics when assessing safety. They strip away context. Use meaningful ratios instead, like combined coverage, times charges earned, and realistic stock value ratios.
And finally, the eighth check. Study how management has actually treated capital providers through weak periods historically. Stability of the stock's price quotation over the last few years is not the same thing as true stability of principal during a crisis.
That is a very comprehensive way to sum up the chapter's mechanics.
Before we wrap up, I want to revisit one of the most powerful philosophical lines in the entire chapter. Graham and Dodd write that matters of form, title, or legal right are relatively immaterial, while the showing made by the individual issue is of paramount importance.
That really is the philosophical center of gravity for security analysis. As investors, we are constantly tempted by cognitive shorthand. We love labels. We hear secured or convertible or investment grade or exchange listed or 30-year dividend record, and our brains just want to turn off and trust the label. Graham and Dodd forcibly drag us away from the label and back to the exhibit. The actual earnings, the total deductions coverage, the exact capital structure, the inherent business stability, and the management incentives.
Because there is no permanent refuge in labels. Form offers no protection if the substance is hollow. You always have to come back to the raw facts. The disciplined investor does not look at a prospectus and ask, what is this security called? He looks at the balance sheet and asks, what does this security actually depend on for its survival?
And when it comes to preferred stocks, the answer to that question is, it depends on the exact same things a bond depends on, but it requires significantly more caution, much wider earnings coverage, a larger equity cushion, and a deep, healthy skepticism about the latitude of management discretion.
It leaves you wondering if complex legal wrappers, like non-cumulative preferreds, historically served to obscure risk from the investor, what modern financial instruments sitting in our portfolios today are doing the exact same thing under a different name. What are we buying right now that looks like a bond, but is structured to leave us stranded in the middle seat?
That is the exact question Graham and Dodd would want you to ask. Higher yield is not a gift. It is a signal to do the rigorous math.
Thanks for joining. If you found this useful, like the episode and subscribe. It really helps us keep these lessons free.
Tell us in the comments what you would like us to tackle next. We could dive into owner's earnings, dividends versus buybacks, return on invested capital, capital structure, or even margin of safety. We want to hear from you.
You can also leave questions from this conversation, and we may build a future Q&A around them.
Thanks again for listening to Capital Allocation Lab, where the mission is simple. Clear, timeless investing principles explained for today's long-term owner.
Subscribe and like to support more educational episodes. We will see you next time.